This is the Prime Pod. My name is Robert McLean, and I'm here today with David Štrouf, who recently joined Savills as Associate Director on its investment team. David's career has taken him from real estate analytics at Cushman Wakefield to private equity consulting at Boston Consulting. He's been involved in a wide range of commercial acquisitions, including due diligence exercises and value creation. David, welcome.
Thank you, Robert. Happy to be here.
You started in real estate on the analytics side at Cushman, but then you moved to private equity. Talk about what you were doing there at Boston Consulting and how it's prepared you for the current role.
I mean, in the end, it's not that much different to what you would expect from investment side in a consulting in real estate like Cushman's or Savills, right? Like it's not that different. In the end, I was part of the PE team here in the Prague office. Majority of my work was actually done with our German colleagues, because that's where now the HQ of BCG is, pretty much, I would say, because that's where the CEO sits. And I mean, in the end, I was part of the same types of DDs that you would do in real estate, just on different types of assets. So typically it would be from logistics to tech, some fintech, recently a bit of medtech. That was my prime angle.
Mm-hmm. So but you also made this a switch from analytics to more of these being on the deal side of things. Is that right? And how did you come to that?
Yes and no at the same time, right? Because I was still part of the, let's say, ground team doing the analytics. Okay. So the way that the kind of MBB consulting is set up, you have all the partners kind of doing the deals. But at the same time, you need that analytical team. I was part of that team specifically. Mm-hmm. And at the same time, the function of a commercial advisor in PE is slightly different to that of a commercial advisor in real estate. Because in real estate, you blend the broker and the commercial advisor function into one. Whereas in the, let's say, classic PE world, that function is typically taken by the investment bank advising on the deal. Mm-hmm. That's doing the structuring and the financing advisory typically. And so the commercial, I would say, advisory in classic PE is a lot more targeted. And it's frankly the main focus of it is the business model of that particular target viable? Mm-hmm. And that's the main question, and that's what you answer.
Right. Whereas in real estate, you're looking generally at a specific asset or a portfolio, and you're looking at the business case.
Exactly, but that's the same function.
Sure.
But as a commercial advisor in real estate, your function is also to market the asset, to help with the structuring, to search for financing, right? Mm-hmm. All of these functions that in a classic PE you would someone else would be doing that. Right. In the real estate, that's blended. Main reason for that, I would say, there's just typically not enough margin to kind of, I would say, make space for the type of fees that you would need to have multiple advisors. Plus, the level of depth of knowledge you need is a lot deeper when it comes to the local market. That's why I think it works in real estate slightly differently.
Okay. And what is it about right now that makes your experience on the private equity side interesting? I mean, you're going to be working, if I understand correctly, to a large extent with private equity investors. Do you think it's going to help that you have this experience on what will essentially be the buy side?
I would say so. First of all, I mean, it's not like buy side, sell side, because typically it's a P trading with a P, and I've done both sides. Uh-huh. That's the first kind of thing that I would say. But secondly, I think where you have a certain, like if you kind of expand your knowledge, whether it's, PE, real estate, it usually gives you a slightly different perspective. Mm-hmm. You understand a little bit better how I would say, big institutional investors worldwide work, because my clients typically were really the top big names that you would know in the PE world. And that, I think, brings a certain, I'd say, different perspective to what you might have here locally.
Okay. Now, tell me about the market here in the Czech Republic in terms of private equity firms that are involved or funds that are involved in real estate. Right. How has it grown, say, over the past 5 to 10 years?
I'd say in terms of like I would maybe start talking about PE overall in the Czech Republic, because I think it's an important framing. And that is that I think PEs here, frankly, local ones up until very recently were almost non-existent. Like, you could argue that some of the family offices that we have historically are PEs, yes, to a certain extent, but not in an extent that would be like typical in the in like the global world, right? Because here you have very strong family offices coming off the backs of how our economy transitioned from, communist era to nowadays,
right.
And that created a large pools of money held in private hands. So in terms of local PEs, I think the first ones that we see are actually upcoming now. You can see that with, for example, what Penta is doing with their new fund. This is the type of really, when you are looking at a PE, that's the type of PE that you would be looking at. And you have other examples, whether it's BHM, whether it's Jet Investments, like these are the, I would say, more kind of classic PE examples. When it comes to the international investors coming into the Czech Republic, I mean, in PE, it's, in classic PE, I would say, they typically buy, the really successful local companies. Example for that being Carlyle buying effectively Paketa, right? I mean, it's those are the I think CVC buying, and I'm not sure whether I haven't gotten them mixed up. CVC buying Melpta. These are the types of deals that we are talking about. When it comes to real estate, I mean, historically we had them here, right? Like if we think about, like, for example, the Residenmo portfolio that was created by Blackstone and then have subsequently sold to Heimstaden. This is the type of stuff, like PE has always been here. Whether it will become a driving force here locally, I'm not so fully sure as of now, but I think there is an angle for it.
Is there a generational aspect to all this? I mean, you were talking about family offices. Are they slowly morphing over time into a more classic private equity structure in terms of like how they're organized, what their goals are, the way it's run? I mean, typically you'll have the head of the family, whoever it is, running the company. They tend to do it on instinct from business, from their own experience, and maybe they get some advice. But at some point, these companies that go on, even for, say, for inheritance reasons or for keeping the wealth within the family, or they create more standardized structures, incentives, goals, and sort of methods of growing. Is that part of what's going on here? And especially, is that what the opportunity for you is, as you see it?
Most definitely. I mean, I think prime example of that really is PPF. Like, that's almost without a doubt exactly that example, where you historically had a couple of very strong individuals effectively driving that company, and whether it was Petr Kellner or it was Mr. Schmeitz or someone like that. Yes, that historically was the aspect, but obviously with the changes that happened to PPF over the last couple of years, you can see a lot more, I would say, professionalized approach. You can see silos being created within that company with particular angles of what people are looking at, whether that's real estate, whether that's their business in logistics, nowadays, whether that's hotels, right? Like, in the end, that's exactly the type of development that you would expect. So, and I think that can be seen all across the main, I would say, family offices.
Is private equity actually interested in real estate right now in the Czech and Slovak markets?
Yes, it is. And when we're talking about the global investors, they're facing the same hurdle that any institutional foreign fund is facing, and that is just the strength of the local capital nowadays here and being priced out. Like the appetite is definitely there. It's in I wouldn't say it's sort of the classic buy an asset, improve it, sell it type of strategy. It's more like, okay, it's development. It might be some platform acquisitions, these types of plays. Because PE by nature is a lot more flexible in terms of what they can do. And therefore, I would say that what they need to be looking at here in terms of, like, if they actually want to enter, they need to be a lot more creative than what you would normally expect.
Just to be clear, you're talking at this point about foreign private equity firms coming in now and looking for opportunities, as opposed to Czech ones that are here on the ground now.
That's what I'm talking about primarily.
Okay. And you are targeting which?
I would say, like, in terms of us as Savills, or
yes, you as David
me as David Štrouf. I mean, for me, the angle is primarily, I would say, the foreign ones.
Okay.
But in the end, like, the local ones are becoming a driving force, and you can see that whether that's company, like whether that's entities like Jet Investments, mm-hmm. or whether it's Penta, a new fund, etc. Like, in the end, it's the same. I would say it's the, how to phrase it, but I would say it's the same type of goals that these people are looking for.
Now, you said it tends to be PE firms buying from PE firms. Is that specific to real estate? Is that in general, or how does that apply here? I mean, what would the potential exits be? Because I think that's one of the main questions, I think, for the Czech market is there actually an exit at this point? I understand right now that there are firms that are selling off. There are foreign firms or larger firms that have held a property for a long time, and there's plenty of Czech capital that's willing to take that on. Different question is what sort of new money is going to be coming in to buy these properties.
I think in terms of like talking about the foreign investors, then I think, or in terms of who's buying what, I think like the classic real estate transaction that you would have in front of you, standing asset, kind of, generating certain type of revenue, might have a bit of value add potential. That in the end, with the current level of pricing and the saturation, it's most likely gonna be either local capital or classic real estate institutional capital. And whether that's local or foreign, that's a different discussion and type of investor. But in the end, that's not something that I would envision to be a classic PE target. And I'm talking the big PEs from globally, right? But like, in terms of what they could potentially be looking at, I think it's asset classes that at this point are not as prevalent in the Czech Republic, whether that's data centers, whether that's PRS, it could be student housing, it could be, in the end, it very frequently is healthcare or some form of care, whether it's for the elderly, etc. Like, so this is and then you start thinking, okay, if I create a portfolio that is large enough to draw interest from the Blackstones, KKRs of the world, then that's my exit if I'm local. But the PE will most likely not create something from scratch, right? Like, but they can offer you quite a good pricing on platform deals where there's a certain element of operation that increases, where you have to, whether that's in the care homes, you have to take care of all the staff. The business model is different than what a classic office asset, right? So these are the types of deals that I envision them doing here. Whether there is market evidence for it so far, not really. Is there market evidence elsewhere? Yes.
A lot of the funds, so the Czech funds that are buyers right now, that when they're acquiring, in many cases, I don't feel that there's any real pressure that they're putting on themselves, or that that their investors are putting on them to spend 3 to 5 years improving somehow the value of it and then exiting. Private equity is different.
Right.
It tends to want 3, 5, 7 years of them. They need to go into something, know that they can increase the value in some way, and then put it on the market. I would think generally as quickly as possible. Is that, I mean, that applies for this market as well. Is that right? And I mean, do you think are they confident? Do you think there's going to be the ability for them to make that exit in 5 years again?
It depends on, first of all, it depends on what type of PE you are talking about. Because a PE by nature, yes, they are more opportunistic, but they have multiple funds, right? They have different types of investors. I mean, while people might allocate money to their tech business, at the same time, they want a certain part. Their investors want a certain part of their own portfolio that's a little bit more conservative, and that's when the PE can come in, right? Like, not all PEs and not all PE sub funds are targeting 20% plus IRRs. Many of them are, but by nature, not all of them. So if in the end, like if you look even at the local structures, you might have a part of the PE fund that's looking at, industrials and really heavy engineering and making their returns there, and these can go into very high IRRs. But then you have a subset, then you have a different sub fund that's very happy to do like local assets.
So within the whole portfolio that they're going to be investing in, real estate is what percentage typically, if it's possible to say, and what kind of returns are they targeting?
I would say still the returns are more value add / opportunistic, definitely. So that's why I would say at least the discussions that I'm having are usually focused on topics like industrial development, retail park development, like development angles where you can provide equity
so that's
or JV with a current developer. I would say that's the kind of classic model when it comes to real estate.
Okay. Because they want the exposure to the development risk and potential
You want the
gain.
exposure to risk. Exposure to risk should equal to higher returns, right? That's the main angle here. So yes, that is definitely one angle. Other angle, not really seen here as much, is private credit. Right, that's another way you can bridge, you can effectively form a bridge loan for a particular moment because a developer or a current owner might need it. And that's obviously lower returns than what we were speaking about before, but still considerable ones. And in the end, the PEs are facing a very similar problem that you have in the Czech fund market, and that is massive inflows, a lot of liquidity in their account. If they can deploy some of it for 18 months to generate a reasonable return of 10-12%, which might be or a little bit less in terms of private credit, but it can help to bridge that time before you find the right asset or the right target to actually deploy it to.
So does that mean they're willing to provide equity, bridge financing, senior lending? I mean, are they willing? Is it flexible in that they'll come in any part of that, capital structure, basically?
Yes, definitely. I mean, then it becomes a topic of, am I talking to the right PE for my needs, right? Which is frequently the job of an advisor like ourselves to map out the market and understand, okay, these are the different opportunities that people are willing to enter. I'd say the big players are going to do the classic either JVs on development or preferred equities in some way, or just direct acquisition. That's sort of the classic. But you might have other, whether it's mezzanine financing, whether it's some form of a bridge loan. You can see these structures. I wouldn't say that in large numbers in the Czech Republic, and we don't see all that's happening on the market, but yes, that can happen.
Most people, anybody who's watching this, has probably saw what happened in the 2010s. We had ultra, I would say, hyper low interest rates, in which essentially anybody could make money in real estate. You didn't have to get a lot of things right. It's a very different scenario right now. How is that? I mean, how did that work in the private equity world? Was that a great time for private equity, or is it now when you have, let's say, normal interest rates? Is this a better opportunity for investments for private equity, or does it never change? Is it always an opportunity based, and then you look for the right ways to invest in a particular type of asset?
That's a very good question, to which I would say I don't think the driver of PE's choice to do a particular deal is necessarily interest rate as much as it is for a classic real estate fund. Because for a classic real estate fund, the impact of financing is massive, right? Like you're targeting different returns. I think a PE is really and I'm talking holistically, not just real estate. PE is looking for the right type of deal, right? And whether the financing in this is how expensive that financing is obviously important, because you are going to do some form of a LBO type of transaction most likely. But in the end, it's about the target you are acquiring, and if it's a company that's relatively nascent, might be a market leader in 2 or 3 countries, then what I'm primarily looking at is how can it grow? Does it have the right to win in different markets? Is it bringing some form of a competitive advantage that no one else has? In real estate, I would say it's more kind of copying what you would expect from a classic real estate investor, qualified investor here. It's I don't think the difference is that big.
Okay.
But within a PE, the main point is you have obviously competition in between the individual, let's say, sub-funds for capital that they have. Right?
Right. Okay. That makes sense. I think in general, things like private credit, private equity, it feels like there's an opportunity that wasn't there, say, pre-COVID, in the sense that banks, I think the typical lending banks, at least in Europe, have taken something of a step back. They've become much more careful. They become more risk averse, I would say, to how much they're willing to lend into real estate. They're using ESG guidelines as maybe a way to cordon off what they will and will not go into. Is that part of the opportunity? I mean, you have a lot of existing sponsors who are looking for capital in a way, and I would think that potentially is a way. Financing they might have assumed they could get from banks that may or may not be renewed. So
absolutely, and I think you've hit the nail on the head there, because in the end, I think this is one of the few opportunities where we're talking about the classic commercial real estate as we think about it, where PE can enter, and one of them is private credit, as you've mentioned, and whether that's a specific PE providing a bridge loan to an existing investor, existing owner of an asset, to kind of bridge this period where they, for example, can't get financing, etc. It's going to eat into their returns, sure, but it might also mean that they don't have to be a distressed seller. At that point, it makes sense. The other next bit is essentially the distressed sale, right? Like, so if because of my financing I'm unable to really hold the asset for a long time, then I'm forced to sell, and then that's where the PE can come in. Question is, can it be competitive enough to compete with all the individual other investors here locally? I'm not so sure, especially with the level of capital that is available in the Czech Republic. But this is a Czech Republic specific issue, I would say, or not issue, reality of the day. Whereas I would say, if you are looking at the Western markets, Germany, UK, then obviously there the opportunities, there's more of them, especially now since the financing is becoming more expensive.
Okay. I realize you've only been back in real estate now for about what is it, 3 months? 3 months
something
now.
like that. Yes.
But what is it? I mean, from the people you're talking to, I assume you're just talking to as many people as possible, getting as much of a view on sort of the dynamics of the market. Is 2025? Do you get the sense turning into like a stronger year perhaps than was expected? And what is it you're expecting for 2026 in terms of like the level of market activity?
I mean, in terms of this, I think 2025 is definitely very good. I'd say 2025 is a very good year in terms of giving a signal that the market is recovering, and that there is certainly a level of pent-up demand. People are willing to buy. We've seen that overall this year, where we have we're targeting, I think now we're looking somewhere between 3.6 and 3.9 billion euros in terms of investment activity, right? So this is obviously coming back to levels pre-COVID, coming back to us kind of the interest rate hike, etc. So there is, first of all, excess liquidity, and funds have incredible inflows, and I think we hear that from pretty much everyone. And secondly, you have kind of, I would say, how to put it? Secondly, you have some form of a return of optimism. I think that's in terms of just investor appetite and belief that, look, like we are able to again do interesting deals, fund value, where perhaps we couldn't see it before, and be a little bit more creative. I think that's overall a good topic for the market to look forward to. And I think 2026, while it might and most likely will not reach the same level of 2025, because frankly, I mean, the deals that needed to happen did happen, and we have a couple of really large transactions. We internally don't think that it will go massively lower to the levels that we've seen, 2022, 2023, kind of where we were somewhere below 2 billion. I don't think that will happen in 2026.
Okay.
And I mean, when we look at even our deal pipeline, there's still activity and there's still buyers that are just extremely keen to acquire something, and at the same time there's sellers who are reaching their horizon in terms of when they need to actually start selling their assets. So.
Okay. And any signals that there could be a pickup in the level of, say, foreign fund activity? I mean, I think we hear of people being in town, for example. Do you see that moving over into taking part competitively in some kind of in tenders for assets?
Yes, I would say so. I mean, just coming from our, expo was 3 weeks ago right now, right? So just coming off of that, I think we see an increased appetite to enter Czech Republic or re-enter it, or effectively build presence here. Obviously, the most kind of prevalent discussion point is, can we actually compete with the local capital? And and there probably are more educated people at this point to comment on that. I think overall, the foreign investors, when they come here, they have a bit of a tendency to look at it as still, especially from Western Europe, as a sort of secondary market to Germany, UK, etc. And unless they have been here for a long time, it's difficult for them to understand that local investors are willing to be more aggressive in their underwriting, more aggressive in the, believe that rental levels will grow, understanding the fact that just overall we have not enough of construction. We don't, I would say the supply is not, supply of new, for example, offices in Prague is just extremely low, right? And therefore the locals are willing to accept the fact that, they can be a lot more bullish on the local market than the foreigners. On the other hand, at the same time, I think there are many funds that started to understand this reality, and they have a certain target that they want to build out here, and they see the opportunity to do it here. Depends whether that can actually transform into deals. But overall, coming back to your question, I'm getting a bit on a sidetrack here. I think, yes, definitely, there is an increased activity. Remains to be seen whether it can actually transform into successful deals. That's a different topic. And we saw that on Palladium, for example, right? Like this was a landmark deal. You had plenty of foreign interest, but in the end, the locals just took over.
Because we always sort of come back to these same questions. It sounds like a slow, grudging acceptance that the valuations that buildings are being sold for here are in some way valid, because I think there's been a mistrust on the part of some foreign investors. It's a combination of mistrust of that the valuations can be really what they are, and their own sort of issues, I would say, at home, what they need to, whatever sort of that they were dealing with within their own funds and their own investor base. But it sounds like both of those things are slowly coming together: an acceptance of valuations and an ability to look abroad as well.
Yes, I would say so. In the end, I think Czech Republic is, and coming back to the first discussion we had at the beginning, why commercial real estate advisors or overall the industry works slightly differently to that of the PE world. And that's where kind of, I think it's difficult for the international investors to fully appreciate that, is that the locality of real estate for a specific country and a specific market is just completely different. And you can have trends that go completely opposite to the neighboring country, for example. And while you, as a global investor, you are going to look at all the opportunities in the world, and you're going to look at Czech Republic, and Czech Republic is disproportionately more expensive to what you would expect if you're looking at, if I'm a pan-European fund and I look at every single country, then Czech Republic is expensive, yes. But why is it expensive? The reason why is because market evidence proves it to be. And until that point where there are willing buyers and sellers at these price points, then that's the until that stops working, then that's the market reality.
I suppose talking about the Czech market in general is maybe part of the problem, you should say, the Prague office market, the Prague retail market, because that puts it in a different light. There's no disrespect to Ostrava or Brno, but capital cities in EU companies are capital cities.
And I would go even further, honestly. I think when you talk about Prague office market, you have Prague CBD office market,
sure,
right? And then you have Prague 4 submarket. And even Prague 4 is different when you're talking about Pankráč, or if you're talking about different locations within Prague 4, just because of the sheer size of that submarket. So, and that's the main reason why I'm saying that in the end, the local knowledge is essential. And when we are talking about foreign investors coming here, I think that if they want to be successful, they need people on board who really know these markets. And there are some who have them, and there are some who have been historically successful here. It's more about, can they actually transmit that knowledge into, for example, their investment strategy and the business plan that they present to their IC, and can they properly kind of transmit this belief in the Prague market or in the Czech market into what they present to their individual investment committees, and subsequently be willing to actually accept the pricing that is prevalent here.
David Štrouf, thank you very much.
Thank you, Robert. I appreciate it.